Okay, hello everybody. Welcome to Korean Atlanta Mentorship here with another Velocity Banking review. And it's actually been 2 weeks since I last posted a video, and I know for some of you, 2 weeks is a very, very long time. And so that's why I decided to post this picture. I'm still alive, and payment going to debt, Velocity Banking, blah, blah, blah. I like how the AI got this one wrong, where the balance goes up over time. Yes. Oh man, the balance of the debt will go up over time, even though you're putting all your payment to debt. All right, and we got a comment here. We were wondering what happened to our cult leader. Well, your cult leader is fine, at least as of today. And that's what we're going to do today. We're going to brainwash ourselves into getting ourselves out of debt. And if you don't know who I am, I'm going to financially flex right here. I'm just a guy on the internet who is trying to create a cult and become a cult leader, and who also paid off a mortgage in 2 years and 9 months. I mean, I've probably flexed 100 times about this on the channel, and I don't know what else to say. You know, I've always said the hardest thing about teaching velocity banking, when you've kind of done things like pay off a mortgage in 2 years and 9 months, is actually teaching it. It takes a lot of discipline. And you might be, no, man, if I were debt free or I paid off all this debt in an instant, I'd be like uploading YouTube videos and getting excited about it. No, no, that's not true, right? That's not true. That's like trying to teach people how to get drinkable water when there's drinkable water in your country, right? Like if you're debt free and you pay off a mortgage in 2 years and 9 months, okay, like you have no desire to teach debt payoff strategies to anybody. Okay, it takes a lot of discipline for you to do that, right? See what I mean? You think you'd want to do it, but that's because you probably need help with debt payoff. All right, so let's go ahead and get started. So what's velocity banking? Well, it's just a debt payoff strategy where we throw all of our money into debt, and hopefully the balance of the debt still goes down, right? Doesn't go up. And that's what we're going to do today, pay off our debt. So first step to velocity banking is create a budget. So we have a budget right here as the average American, income, expenses, and leftover savings. And then our expense breakdown, we list every single debt that we have. We have 4 credit cards, we have 2 auto loans, we have a student loan, a mortgage, and we have our expenses that are not debt, which is food, gas, insurance, and all that other stuff. And we put this random number of $2,000 a month, which hopefully is accurate, right? So according to this, we're actually spending about $3,138.33 on necessities, right? Because a lot of people would consider a mortgage or your housing payment to be part of your necessities budget, although in this case, it's actually a debt. So that's why we separate it. And so what we're going to do with velocity banking is the same income, same expenses, right? But we're not going to save money. Okay, so this is the scary part of finance. Okay, personal finance, because everywhere you go, you always see like, oh, you gotta put money into a savings account, right? No one says put all of your money into debt. That's ridiculous. And we're going to put money into something called a line of credit. So what's a line of credit? It's basically a financial tool where you could pull out money, pay it back, and then use it over and over again, right? So like this home equity line of credit here for $373,500, right? Home equity line of credit. And I have many lines of credit, including credit cards, because it's a credit card is a formal line of credit. You swipe it, pay it back, and then use it over and over again. That's a line of credit, right? And so here, and I'm going to flex here again, I have up to $739,000 in lines of credit. That's right, $739,000 in lines of credit. Look at all these lines of credit, including credit cards, personal lines of credit, credit, blah 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 blah, home equity line of credit. And I'm gonna tell you the secret to getting all these lines of credit, which is that banks don't lend money to people who need it, right? So very important. Now I know a lot of you out there don't understand how lending works, right? And so a lot of you haven't, let's say, gotten over the step one problem, which is the income problem. That's kind of like what Dave Ramsey talks about. Like, oh, you don't have a I forgot what he says. Like, you don't have a debt problem. You have an income problem or something like that, right? You need more income. And so as you get more income, well, guess what happens? Okay, you get more debt offers. And this is why, like, every time you pay off a debt, like, people always say, like, hey, like, whenever I paid off one of my loans, I'm just getting more debt offers in the mail. And that's because they know when you don't need money. Okay. And the secret to this is just always pay off the debt quickly. And the banks always see that, hey, we don't lend money to people who need it. And they could just track, they have your address, they track your data, right? And then they're going to mail you offers and say, hey, take some debt, right? That's how it works. But the secret of how I got all these lines of credit is I just always went to a bank or a credit union when I didn't need money, right? Because banks don't lend money to people who need it. 739,000, top 0.01%. Okay, top 0.01%. That's right, top 0.01%. And so what we're going to do here is just kind of show you how we would pay off the debt. And so I'm going to do this, which is get my income minus my expenses. And then we see that we have this number called cash flow here, but here's the difference between here and here. We're not going to save money, right? So if we take a look at this bank account snapshot, you see that 19 grand came in and then 19 grand went out. Okay, 19 grand comes in, 19 grand comes out. Folks, if you ever get to a point in your life where it's like, oh, 100 grand came in and 100 grand came out, and you don't ever think it's a big deal, and I'm not saying I'm there yet, but maybe I might get there soon. I don't know. That's how you know you're in the top 0.0001%, right? Top 0.00. Now, let me just kind of show you here. All right, so this is $1. So what we're going to do is we're going to assume we have access to a big line of credit. We have $250,000 free and clear. Now you might say, well, how do you get a free and clear line of credit when you have $1 left over? And the answer is you don't, right? I'm just showing you what could happen if, by the grace of God, you got a free and clear line of credit. It would probably change your life at this moment, probably. But that's kind of the trick or the deal, is that you only get a line of credit when you don't need the money, right? This is why, like, you know, when I was poor and broke, I was like, oh, it's so unfair that the bank won't lend me money, right? And the reason why they don't is because they already know at an institutional level what human beings do. You ever have a friend who begged you for money and was like, oh, I need money, I'm begging you, right? And you lent them money and then never paid you back? Bank knows that too. So that's why they don't lend money to people who need it. Can't do it, right? But so let's go ahead and do this. And what we're going to do is we're going to move some of our debt into the line of credit. And then one of the easiest ways to figure out which debts to move is just use something called the cash flow index, which is the balance of the debt, 5,000 divided by the payment, divided by 175. So 28, 28, 30, 30, 54. So basically you take the lowest ones, right, and then you move them into line of credit to increase your cash flow. So the higher the number, that essentially means you get less bang for your buck for paying off that debt. Okay, so for example, you give someone $270,000 to pay off a debt, and you only get $1,100 back in cash flow. Pretty bad deal, right? Whereas with these credit cards, you give $35,000 and then you get $1,100 back in cash flow. It's a pretty good deal. Okay, so what we're gonna do is move these credit cards, and how much is that? It's 530, 735, and then whoops, not 335, and then we're gonna sum it up, and then this is gonna be $77,000 in credit card debt. And guess what happens here? Oh my goodness. Oh man, 0, 0, 0, 0. This is the part where you show people and then they just don't know what to say because if you were listen, we didn't make more money, right? And if I go ahead and hide this and you just show people this, like, oh, look at all this debt that we have. We have like $1 left over. What are we going to do? Okay. And everybody's gonna say you got to make more money. I was like, no, you don't. Just use all your money, pay off the debt, and then use your line of credit to consolidate. right? Increase your cash flow. Use it for the flexibility. And so now, final step is we put our entire paycheck into the line, take our expenses out, and then rinse and repeat over and over again. 7,000 in satisfies the minimum monthly payment, right? And then step two is that it lowers the average daily balance, therefore kind of decreasing the interest. And then we use our cash flow to reduce the balance of the debt. Now take a look at this. $1 in savings, right? $1 in savings versus $2,591 in cash flow. Which one do you prefer? I'd rather not save the money, right? Rather not save it. So let's go ahead and do this. And I'm going to go ahead and calculate the latest balance interest minus the cash flow. So our cash flow is 2591. All right, let's go ahead and do this. And then what we're going to do is take the average daily balance, multiply by the interest rate, 0.08, and then divide by 12. And then now I'm going to copy and paste, right? So let's go ahead and copy and paste. And then we see, bam, 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 in month 34. Okay, month 34, this is all paid off. All right, so let's now record in our milestone. So 34 months. And then this is going to be 77K, right? So 34 months. And then now what we have is the auto loan, student loan, and the mortgage. So the amortized loans usually get paid off last. And then what we're at month 34, so 34, and now I'm going to copy and paste. And then we see the current balances here. And again, just use the same cash flow index formula. So we have these loan ranking numbers. And I'm going to go ahead and copy and paste. And then what we're going to do is we're going to sum it up. And then this is going to be 19 grand. And I'm going to do this. Okay. And I'm going to do this. So this is going to be plus 19682.05. Okay. And then we're going to scroll down. Hold on. 1, 2, 3, 4, 5. Actually, I'd even increase the cash flow, right? Because what we did is we took off the 2 auto loans, and then so now these turn to 0. And then bam! Cash flows over $3,382.27. All right, so we're going to do this. And then I'm just going to do 382.27. And I'm going to do this, and then now this is going to be like 40 months. 40 months. And then this is going to be 77. Whoopsie. 77. Whoa! What's going on here? New keyboard. All right, 77 plus 23 plus 20. And that's going to be 120K. And then bam, bam, right? And then student loan and mortgage. And so now let's get to the student loan. So this is going to be 40. And so bam, bam. And now we're going to move the student loan into the line of credit. And then alakablam, this is going to copy, paste. And then it'd be plus 75037.7. Okay. And then now student loan is 0, right? And then blam, 4595.55. Look how easy your life becomes when you don't save any more money, right? But then everybody else thinks that you are irresponsible for not doing that, including every time you get a loan. And you know what's crazy is that every time you get a loan, they want to, like, especially a huge loan, they want to see some savings in your checking account. But like whenever you get a line of credit, I've never been really asked if you have any savings for that line of credit, right? It's kind of weird, or I don't know if it's weird, but it's just how it is. Okay, so let's see. Did I 4595.55? All right, so we got that covered, and then month 57, we got that as well. So 57 months, and then that'd be 220K. And so now month 57, we're right here. So 57 says 241,000. Original balance is 270. Now, what we can do, we can pay it off in 2 ways. Number one, we could just dump all the extra cash that we have into the loan, right? There's no problem with that. It will pay it off relatively quickly. Now, why don't most people do that is because throwing all of your money into a loan is kind of I wouldn't say it's hard. It's most people won't do it just because when you put your money into the loan, you don't get it back, right? And you can obviously use your line of credit as backup, but the thing that we don't want to do is segregate our income. That's why we like to put all of our income into one place, right? I mean, how did we get here in the first place? Is because we started segregating our income. Income comes in, gets paid off, it gets split into 20 different places. Actually, 1, 2, 3, 4, 5, 6, 7, 8 different places. And then yeah, it gets split into 8 different ways. Okay. And then yeah, 8 different ways. And then what am I even talking about? What am I even talking? I don't even know what I'm talking. I'm just kidding. Um It's what happens. You get distracted and you don't really care. When you pay off a mortgage in 2 years and 9 months. Oh, did you see that flex? No, I'm just kidding. Okay, so all right, so we can put all of our extra cash into the mortgage or still use a line of credit. Now, here's one of the reasons why I might even use a 30% credit card to pay off a mortgage. Okay. Now, if you decided between, let's say, a 3% line of credit, which doesn't exist, or maybe they might have like what do you want to call it, introductory rates, versus a 30% credit card, obviously I choose the lowest interest rate tool, right? But I might still use a 30% credit card because even if I do use a 30% credit card, so let's do 30% here, and let me put in the formula here. So 270,000. What's the current balance? It's 241,653.78. 241,653.78. And then what's the payment amount? The payment amount is 1138.33. So 1138.33. And their monthly income is 7733.88. And then our expenses is everything except for the loan we're trying to pay off, so $2,000. So I still pay it off in 30 with the 30% credit card in 3.8 years. Now let's move this to 8%, right? So there's a $5,000 difference. Now you might be saying, why would I want to use a 30% credit card? Because, okay, the best credit decision is not the best financial decision, right? So you have to understand, one of the main reasons why a lot of people can't get credit is because you have to go to a bank when times are good and you might have to give them a little bit of money. So if you take a look here, this business credit card used to be $10,000. Now it's $17,500. Okay, I literally woke up and then I just logged into the bank's website and it was $17,500, and it's like, whoa! And that's because I was using it a lot to set up an Airbnb. So you can see right here Airbnb figures, and let me go back here. $17,500. Yeah, $17,500. What are we talking about? Top 0.01%, right? That's how much more can I flex? That's really all these YouTube videos are, is just how much can I flex. Okay, so now back to here is one of the reasons why I might use the 30% credit card is just so that if I keep swiping, they'll probably increase my credit. And one of the benefits of credit is that credit is a money access multiplier, right? So um, I have never in my life saved, let me just go back here, $739,000 ever, right? Never saved that much. But even though I've never saved 739,000, I was able to get it because I gave money to the bank, just a little bit, so that I can give a lot more in return, right? So it's like, would you pay a bank $3,000 to get $380,000, which is essentially what I did when I got the home equity line of credit, right? And so again, one of the reasons why I talk about the this and the chunking and all that is because a lot of people, they're so afraid of like interest rates. Like like if you ever watch the news, if if the Fed interest rate like moves up a point or down a point, then it really like affects the housing market. I really don't care. One of these days I might actually just you know, just kind of you know, I'd obviously get a mortgage that's the lowest rate possible, but I'd still chunk it off of 30%, so I can just kind of use that credit card and get those sweet, sweet reward points. And then, you know, with the rewards points, especially with those cash back ones, it'd probably be the same comparable to a lower interest rate line of credit, right? But there's only like a $3,000 difference. I don't know. But yeah, so that's basically what this is. And by the way, if you don't know where I got this cool spreadsheet from, you know, a lot of people ask and say, "Can I just buy the spreadsheet?" And I said, "No, you have to pay me money, more money, right?" So click the Google form link below. I get commission. I don't even get that much, to be honest, for selling stuff, educational courses, and all that. And this YouTube channel is just basically a front for me to make some money and also possibly recruit you into a Velocity Banking call. All right, well that's it for today, folks. Actually, I didn't even write the payoff date, which is 3.8 years. So now this is 0, and then this is going to be 57 divided by 12 plus 3.8. And yeah, 8.55 years debt free. You know, and as I said before, it takes a lot of discipline to teach this when you are debt free, or you've paid a significant amount of debt in a small amount of time. Because I mean, if you were me, would you take the time to make these YouTube videos that take some significant time and effort to upload? Especially since I've made over 1,100 videos on this channel, right? So I'm just being real with you here. A lot of people think that they can do this, but they can't. And the reason why I make these videos is so that I can like practice my speaking and presentation skills. That's the only reason I made this channel. Also, just to flex a little bit too, right? And possibly to create a cult, so that you know if the cult leader isn't active in the cult followers are yearning for the cult leader's presence. Am I really doing that? I don't know. But hopefully the balance when I get the next picture generated by AI goes down instead of up. But yes, that's it for today, folks. This is Crane Atlanta Mentorship. Yeah, and so I know I made the YouTube title as Rich, 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 right? Rich, Rich, Rich. Okay, and yeah, I don't know what else to say. I'm gonna be really blunt with you. Okay, all right. Well, yeah, rich, rich, rich. So if you made it to the I'm sorry, to the end of the video, to the end of the video, here's the secret keyword of the day to let me know you watched to the end. Again, just type it in. Top 0.01%. Just write, I am the top 0.01%. That'll let me know you watched to the end of the video, and then you'll be part of the super secret club of the top 0.01%. Okay? I gotta start making merch now. You know, I've been watching a lot of Uncle Roger videos. It's like, damn, that guy's killing it. That guy's killing it. We might do some Uncle Roger watch parties. But okay, all right. Have a great day, everybody, and I'll see you all in the next video.